Hello and welcome everyone. In this short recording, we are going to discuss about how to analyze financial statements, specifically income statement. So there are two ways to analyze income statement: horizontal analysis or vertical analysis. In horizontal analysis, we try to find out trends. So way of finding out trend is you divide current period's data vis-a-vis previous period's data and subtract one from it. So you find whether vis-a-vis previous periods any particular variable like sales or cost, either is it increasing or decreasing. Then try to comment on it. Then you try to think about the action that you have to take. The second way to go about it is you try to do a vertical analysis. In vertical analysis, you express everything as a proportion of sales. Okay. So the best way of understanding how to go about income statement analysis is by analyzing data. So let's take an example and understand it better. So the company is Puma. It's a European giant that majorly sells footwears and also apparels. So we are going to analyze Puma today. We are going to do both horizontal as well as vertical analysis. I have taken this data from Capital IQ. So I have an access to Capital IQ. So I have taken data from that. Okay. So first is horizontal analysis. So horizontal is finding trends. So you simply find trends vis-a-vis current period as well as last period. So how do you find trend? Current period's data divided by previous period's data minus 1 and express it as in percentage. Okay. So you find out that sales or revenue has increased vis-a-vis last period by around 14%. Okay. I'll just drag it down. So for every variable that is there on income statement, for example, sales, cost of goods sold, SGA, depreciation, amortization, interest expense, income tax expense, as well as net income, we are trying to find out a trend of vis-a-vis what is happening in this period versus the last period. Is it growing or is it decreasing? So I'm deleting everything that doesn't have meaning to us, and then we'll look at what these different things mean. So in the last class we have seen what is structure of income statement. So it flows from revenue to net income to shareholders. Okay, so as you can see, the revenues are growing by 14%. So is it a good sign? So let us say it's good, and we'll highlight it by green because it's a good sign. Then if you see, cost of goods sold are rising by 11%. Now it is also a good sign because they are rising lesser than sales. So your sales are rising at 14% and your cost is rising at 11%. So whenever you see this relationship, you see it in the context of sales. So you compare growth in COGS or growth in any expense vis-a-vis growth in sales. So if sales are rising faster than your cost, then it's a good decent sign. If your cost is rising faster than the sales, then it means that company is not getting efficient. It is decreasing its efficiency. So here we don't see any problem. So let us mark it by good, because COGS are increasing, but they are increasing at a rate that is slower than sales. So sales are rising at a faster rate. SGA is increasing at 12%. So your marketing and all those expenses are increasing at 12%, but your sales are rising by 14%. So again, it's a good sign. So imagine other way around. If your sales or your selling in general SGA expense was rising at 40% and your sales is actually only rising by 12%. So you're putting a lot of efforts on marketing, let's say, or advertising, but that advertising is not yielding you what you thought it would. So that indicates that. Next is R&D expense increasing at 5%. No problem with that. Okay. Depreciation and amortization or other operating expense total increase, depreciation amortization nil, so this we can ignore so it is income, so it we can ignore that. So your operating expense on an average are increasing at 12%, while your revenues are increasing at 14%, so it's a good sign. So operating income, if you see, has shown a huge jump of 92%. So currently it is good, but you need to do some reflection here. You need to try to see whether this trend will continue in the future, because it's a big jump. It is not a gradual jump, it is an exponential jump. They have jumped almost, means almost they have become twice of what they were. So it's a big jump. So it is good currently for this analysis sake, but whenever you are looking to make any investment decisions in Puma, try to see whether this trend would continue or not. Interest expense, as it's actually negative, so it's an income. Interest, and so net interest expense, let's check out. So net interest expense has increased by 159%. That may not be a good sign, so let's highlight it by red and let's write down bad. Okay, one trick here is interest expense is negative, so you are getting certain income from it, right? Then it becomes tricky. So if it is negative, then we assume that it is good. But for the analysis sake or understanding sake, if interest expense increases, then it is bad. But in this case, interest expense has actually fallen, so you are getting interest income and higher interest income here, so it's a good sign. But let's ignore the signs, and let's say these signs were not negative but positive, then what you would have done? If interest expense is increasing, okay, if interest expense is increasing, that's a bad sign. Earning before tax has increased by 95%. That is again good, but you need to dig deeper. You need to find out whether this trend would continue. Okay. Income tax expense, you do not have any control, so that is controlled by government. So no control, so good or bad we cannot control. Okay. Total earnings have improved by 90%. That's a very good sign, but you just need to analyze whether this trend would continue or not. What is something that has increased earnings by 90% when the sales are only increasing by 14%? So is the company is doing away with certain operations that were not yielding results, or is it bringing in certain new technology that is leading to a very low cost? So is it leading to a very less cost or cost reduction that is increasing the profits? Because what is happening, sales are only increasing by 14%, but net income has gone up by 90%. So you need to dig deeper. So this is how you do horizontal analysis. You find the trend and then comment whether it is good or bad. Next is vertical analysis. In vertical analysis, you find out proportions. So everything here is expressed as a percentage of sales. So vertical analysis in 2016 versus vertical analysis in 2017. Let's check it out. How do you do it? So as I said, everything is expressed as a percentage of sales. So sales divided by sales. Okay. So that is 100%. Okay, then net sales, okay, sorry, this net sales is also remaining. Net sales is also divided by sales, that is also 100%. Then you have cost of goods sold, which would be expressed as sales. So every data variable is expressed as a percentage of sales. So I'm making sales constant so that I can drag it. Okay, and just dragging it down, then cleaning up data, wherever you are getting zeros, and putting percentage signs. So out of sales, 2% net income is generated. So if this company is selling $100 worth of product, 2% flows to company shareholders. Rest goes to cost and all. Okay. Let's see what is happening in 2017. So everything expressed as a percentage of sales. So this divided by sales figure and dragging it down, expressing it as a percentage. Okay, I did not make it constant, so making it constant and then dragging it. Okay, cleaning the data. So this 0, this 0, this 0, this 0, here, here. This we don't need. So what is happening? In 2016, if it sold $100 worth of product, 2% of it, that is $2, was going to company. Now in 2017, if it sold $100 worth of product, 4% is going to company. So company has gone more efficient. So efficiency of company has improved. So this is a good sign. Okay. Then if you see, earlier 54% was going to COGS. Only 53% is going to COGS. So operating efficiency has improved. This is good. Then if you see, gross profit has gone up, so that's also indicates operating efficiency. Then percentage allocation to SGA, selling general expenses, has gone down. So less efforts are required now to sell products than earlier. So efficiency of indirect cost or handling indirect cost has gone up. Then we'll hide this so that it becomes easier. Then if you see, income tax expense has gone up, but revenues have gone up also. Revenues have gone up by by almost from 3% to 6%. Income tax has gone up from 1% to 2%. That's okay. And more retention of profits, so more profits flowing to shareholders. So in a nutshell, this is how you analyze income statement of a company, horizontal as well as vertical. In horizontal analysis, you find trends. So current period's data vis-a-vis last period's data -1. And in vertical analysis, you expressed everything as a percentage of sales. So in the next class, we are going to discuss about how to analyze balance sheets.